Good day. This is David Friedman, co-host with my colleague Dave Berkus on TCA Crossroads, where entrepreneurs and investors connect. How are you, Dave?
I am doing great. It's a good day, and we have some good information and a lot to talk about as it relates to what kind of trends we've seen in investing during this first half of 2025. And I'll set the stage if I can, if you'll let me, by showing a little of what happened before. Okay, let me do that. So I'm going to show you, if you'll put up on the screen, the Wilson Sonsini report that doesn't cover the last few months of 2024. And of course, the first 6 months of 2025 hasn't been published yet. So here's the best information we have. And it's interesting to see. And I'm going to give you a very quick kind of a summary here so we can move on this. First of all, the headlines. So David, valuations remain below recent highs and fundraising amounts are a little bit lower. And if I show you what that means, it'll give us something that gives us an element to talk about. First of all, valuations haven't bounced back yet. And that means that we got to extremely high valuations in 2020 and 21. And then they began to decline quickly. It sounds counterintuitive because, as you know, because of COVID, you'd think the valuations would have gone way down. And they didn't until, it turns out, 2022 and 23 and 24. So fundraising amounts remain strong, which is kind of good to see. And we are at the seed stage, and we sometimes are in the Series A stage. But right. Look at the seed stage as it goes to the most recent quarters. You see them well above where they were in 2021. And so that's a good sign. We are raising more funds, which is good to see. Down rounds continue to recede, and that's news for all of us. We all hate to see when companies are weak and other people come in as investors and force the original investors to experience a down round, which means the valuation is lower than the value that we invested at. And sometimes we're required to pay to play. And so seeing that they are receding at this point, we are in a better stage than we were before. The deal terms, investor-friendly deal terms remain popular, which as investors, I guess we love to see. And it's because the amount of investment has decreased a bit, valuations have gone down a bit, and that gave us more power as investors. Convertible note means have increased. So pre-seed notes maintain the momentum, which I guess we can expect. And about a third of all investments are made with convertible notes. And so note interest rates are up, David, and you could have expected that because the interest rates everywhere are up at this point. Right. And that's a sign that is, I think, going to continue. We understand that the Fed is probably going to reduce rates slightly during the second half of 2025. And they've talked about, Chairman Powell has talked about 2 reductions. They'll probably be 1/4 point apiece, so a 1/2 point down from 4.5. Not enough to make a big difference. Certainly not 0 or 1, where it had been for so many years. And then finally, safes have continued to increase, and they're usually under $1 million. In other words, larger deals don't really involve safes. So that gives us the background to talk about. I'd like to change and give you one more slide if I can, which is a bit shocking, and then we can talk about where we are from there. Okay, David, so I've just put on the startup shutdowns. These are the number of shutdowns by quarter, and I realize it only gets to the first quarter of 2024. But look at this. Look at the number of shutdowns that are happening now based upon those companies which earlier on in 2020 and 21 were able to survive a longer period of time. It's the one negative that we have to look at here, and we ought to talk about it and see. So we can take the slides off, David, and continue. But the first question that I would ask for you is, how do you see, for the TCA fund especially, and maybe for a little broader example, the investment environment today for the first half of 2025?
Yeah, I mean, I know Wilson Sonsini is probably smarter than I am because they have a lot more people that are smarter than I am, but I see things a little differently than Wilson Sonsini. And maybe it's due to the fact that we're involved more in the pre-seed and seed, and a lot of the Wilson Sonsini information, their context is more, they do seed, but they're also looking at what the VCs do, and they have a little different slant. I see the environment today better than last year. Part of the reason that it's better than last year is last year we had very few exits. Not only were there greater shutdowns, as you point out, we all saw that. My portfolio got hit by, as I was mentioning in a sidebar with you a while back, got hit with some companies doing pay to play and shutdowns, and it was drastically ticked me off. I don't know how else to say it, but I've seen over the last 6 months and going into the mid-year, some deals that have come to fruition. And we just saw at TCA a 44X deal by our colleagues over at Pasadena Angels. I forgot the name of the company, of course. But we're starting to see the deals maturing and finally coming to fruition. We are seeing a longer length of time in which you need to be invested. The 4 to 7 years is kind of difficult to believe in right now. It's more like 5 to 9 years, even more.
Yeah, and you've heard me say that my average is 11, and that goes through 206 deals.
Well, thank God we're both young. We can handle that.
Yes.
I tell my kids, if it's not me, it's going to be you. But, so I do see a change. And I think the environment, the interest rates are stabilizing. They'll come down, as you point out. I think that's very positive for the investments. And we're seeing different trends right now. And we can talk about that, where people are investing, and particularly where the angels want to invest. There's deals that we're seeing, but angels don't necessarily want to invest in some of these for a variety of reasons. And we can touch on that. So, yeah, I'm actually enthused that the environment is getting better. In fact, I'll just give you one quick statistic, just based upon one of the funds that I'm in Orange County, TCA. We're seeing deals going into due diligence, lots of deals, and deals being accepted. And we're having pressure on our fund because we may run out of money in the fund. So it's kind of interesting, but the deals that I'm seeing, my colleagues may differ, are very good deals, but a lot of them are in the health tech, life sciences, medtech area.
Which requires some expertise in the due diligence area. And also, those deals often look very attractive. I've had this experience for too many years. When you hear that somebody is curing cancer, or they have something that will help in the process in a hospital of making operations more successful or whatever, we always want to believe that those are going to be successful deals. And sometimes they just don't get as far as we'd like them to, the FDA being one of the reasons. So I'm getting a little cautious on those kinds of deals. And now that I said that, DTX Pharma was last year $1 billion deal, half of which was paid out in cash, and the other half, I believe, is dependent upon the next level of FDA approvals. So sometimes you can hit a real home run with those kinds.
Well, I think that's what happens. I think the expectation is to hit that home run. What I'm seeing in the medical area and in life sciences is kind of interesting. I'm seeing a lot of AI in the background. They're using AI to help make decisions. A lot of AI in radiology and diagnostics, AI in terms of developing new drugs, AI in terms of improving the way the clinical trials are done. And then I'm seeing new materials that are coming in that help in the operating theater, like Asperglue, a different kind of glue, or LifeSeal, which does a medical device for sealing aneurysms.
That all sounds kind of exciting. And so let's make a general statement and see if you agree. AI is a tool, not the end game. And so when we see all of these apps and all of these opportunities, AI just enhances their ability to deliver whatever it is they're trying to do. And so early on, when in 2022, AI was the bright, shiny object, we're now seeing AI included in all these very good applications.
Yeah, I think you're 100% correct. It's like the difference is if I had a screwdriver versus a pneumatic gun. You almost have to use AI to help make better decisions. And
Right.
I do think it's augmenting what is available out there. It lets you do things better, faster. Even in our due diligence, we're using AI. I mean, it's kind of interesting. So we can get better insight and we can avoid blind spots. And I think that's where AI really comes in the blind spots, particularly in like clinical trials or in doing diagnostics.
Compliment to you. You're the one who really drove that whole thing about using AI for due diligence.
Yeah, it's a
And
whole group of us, not just me. We did, and a couple of the other angel groups are doing it. But thanks, I appreciate it. It's fun to do actually, and it's really opened up our eyes in terms of the ability to look at deals, because the AI can scour things that we can't, but it still requires human intervention. And that's I think really key. AI is an augmentation. It's a complement to the human brain. It's not a replacement for the human brain. If you just rely on AI in medical technology, material science, in SaaS products, I think you can go astray.
I completely understand that. Let's talk for a second about robotics. I mean,
Okay.
robotics really require AI, but are we seeing any deals at all with people early in the robotics field?
Yeah, we've seen a couple. One who actually was a humanistic robot where the AI would understand your personality. Can do the thing about this one. It understands my personality and becomes snarky with me. I mean, I can see that happening. Same with you, by the way. It talks to you in a way that makes it relatable. So we did see a deal. I forgot the name of it because we've seen so many deals. We see literally thousands of deals a year. But I remember this one gentleman. He came in with the robot. He had this AI system, and it said, "This robot is to make you feel comfortable because it understands your personality and will relate to you in a way that AI normally doesn't." So I can select and choose. I'm not going to make any other comments on that, but it was very appealing, and I can see that being used in certain situations, like instead of a comfort dog or a comfort animal, it's a comfort robot. We're seeing this in Japan. They have humanistically looking robots that will interact with you. So I believe you're going to see these causal AI systems that look at you, or behavioral AI systems that are going to be relating to you and reacting to you as if it were a human, like your friend.
And
Yeah.
in fact, people are talking already. Boston Dynamics has a humanoid robot that they are just starting to show right now. And we're getting close to some of those movies that we saw in the last decade. I'm thinking of the movie Her, if you remember, where
Yeah.
it was all audio. There was no actual physical person.
Well, I'll tell
So,
you, some of the robots I've seen in Japan, they look pretty real to me.
okay, so off the subject, but
All right.
robotics was on my mind
Yeah.
because it is one of the fields that I think is advancing as fast as AI is itself. Any other kinds of fields that you've seen coming into the TCA fund that make some sense to you?
Well, I'll stay on the AI trend for 1 second. We've seen
Mhm.
using AI in setting up social media and marketing. There's a company that I've been working with called Bloomley, shameless plug, I guess. They're looking for funding. Their concept is to develop a 30-day marketing plan in 30 days. The initial focus is on social media. So it gets to know you, the company, and then it will take the data that you have in your systems, blend it with other content, and based upon what your needs are, by answering some questions, the AI will actually generate the content and the scheduling and the kinds of media that you want to be in. 30 minutes, 30-day marketing plan. It's pretty cool.
Funny you mentioned that, because as you know, I brought a company called V30 here from Argentina, and I financed that one without going through TCA. But it's a company that takes all of your own writings, website, videos, and incorporates all that material into providing a 30-day calendar of things you can publish. And I publish using that calendar on my LinkedIn site. I have about 12,000 people who follow me on the LinkedIn site. It is very much a tool that helps me to publish in 5 minutes using my own language, my own materials that would have taken a lot longer to rewrite.
Yeah, I want to go back to a comment you made about valuations and safes and convertible notes, though.
Sure. Mm-hmm.
You know, I remember one of the ones you put up from Wilson Sonsini showed valuations in seed, I think at $14 million or something like that. We're still not seeing the valuations coming down fast enough. And when you're an angel investor, as you know, you want to begin with the end in mind. You want to look what the exit's going to be and see if you can get a decent return. Right. And we're seeing these valuations still stay too high relative to the investments being made, the AI that's being used. If in fact it's AI or algorithms, there's a big difference. You know, people say AI, but it's an algorithm. And what the competitive differential is. So I still think a lot of the entrepreneurs, say that, well, the Valley is looking at deals at $10 million. So what we see a lot the deals that say, well, a valuation's 10 million or 15 million, or they come in and say, well, the Valley says it's 20 million. We're going to give you a discount to 15. I don't think a lot of the entrepreneurs I hate to say it, but I don't think the entrepreneurs are really thinking from the perspective of an angel in the way we look at a deal. And I think they need to understand this angel psychology. But if they come in with something too high, the angels won't even look at it. So it has to be realistic. If I put $100,000 in a deal, the expectation of getting a $10 million valuation pre-revenue is kind of de minimis. If you put in $2 million and you have some revenue, then $10 million valuation may be okay. But we have to then understand what your additional financing strategy and funding strategy is and where you're going to go and whether or not you have a differential advantage that's sustainable. So I just caution the entrepreneurs to do that correctly.
So David, you know that I've been in this angel game for 32 years. And it goes back a long time before the term angel was even invented. And so I can tell you that what you're saying is right, but most all the money that I've made has been because of low valuations going in. And let that one sink in, because the entrepreneur's got to realize that there has to be a real chance for the investors to make a good deal of money, a multiple on their investment. And the only way to do that is by starting out at a reasonably low number. Because if we look at the average successful sale of an angel-based company is $35 to $40 million. Nowhere near the billion-dollar unicorn valuations that people like to talk about. At 35 million, if you start out at a 2 million valuation and you don't take any additional money, you make a lot of money.
Correct.
If you start at a 10 million valuation and you don't take any more money, you might be happy. It's not 3.5x because dilution from the option pool and from other things that happen during the life of the company keep that 3.5 reduced down to somewhere usually around 2.5 times. 2.5 times is not 10 times. 10 times is what we'd like to look at because there are so many that fail. And the bottom line from that chart that I showed you about how many failures there are and they're going up is that we investors have to be protected to the degree that money going in, valuation going in, is probably the real touchstone of our investing experience.
Yeah, so I want to get your thoughts on the following.
Sure.
One of the things we've been looking at is changing our investment thesis. So we don't necessarily have to look at that 10x return. So we can look at dividends or revenue share. We can look at later stage deals. We can look at the secondary market. We can be fast followers where somebody else has done the due diligence, so we're not the first one. Advantages and disadvantages, clearly. I'm wondering what you're seeing in the angel world in terms of changing their investment thesis from, the traditional angel. We invest early. Hopefully you're the only round of funding, or maybe one other round, for the 10, or what I've heard also, the 20x return. I'm wondering how the angel groups and the angels are thinking, just looking at yourself, in terms of looking at a higher probability return, but it may be a 5x in 3 years versus a 10x in 10 years.
I think what you're having right now is a small crisis of people coming in and leaving angel groups because they expected returns too soon. And so if we do have vehicles that allow them to make something in the way of a return early on, it engages them. And I think it will probably keep the angel groups larger and growing. So I agree with you completely. And we have some tools already that can do that. There are secondary markets that we have talked about. We even interviewed George, as you remember, from MDH. And we've had several others like it that allow us to buy into either pre-public companies already prepackaged, public companies. There's a company called MarketX in San Francisco that would allow us to buy into options for some of the larger companies, options from pick one, Meta, where employees have sold their options, made them actually bought stock and sold their options. And we can buy that stock. Now, the returns won't be that great, but the liquidity is the issue. And those two things that I mentioned are liquid opportunities. And I think we ought to blend liquid with illiquid so people feel the taste earlier on.
And I'm totally with you, by the way. That's something that I proposed to look at, and it's something that our executive committees are looking at, whether or not we want to change our investment thesis. It came up yesterday in one of our strategy meetings.
Right.
So I'm there. I mean, I think that would be useful, but that also gets into another issue relating to engagement of members. Remember, last year we had a lot of shutdowns and we didn't have a lot of exits.
That's
How
right.
do you keep a new member engaged when they don't see those immediate returns that they think they're going to get? Now, you can certainly look at shorter term deals, maybe even some real estate or revenue producing deals. But what have you seen in terms of improving member engagement, reducing churn of the members in angel groups? Have you seen anything? Just curious.
Well, the first thing goes back as far as you want to go with the angel groups. If somebody comes in and they are passive, they'll leave soon.
Yeah.
If you give them a chance to lead a deal, be on a due diligence committee, do whatever it is that will get them involved, the opportunity is much greater to keep them for 5 to 10 years or maybe even longer. So I'm a great advocate, first of all, for making sure that new angels coming in are attached immediately to a buddy, somebody who's been successful, and at the same time coached as to what they can do to make a difference within the angel group.
I think that's great. I have one final question. I know we're running out of time, but what do you see or expect at the second half of 2025 and as we approach 2026 in terms of the investing environment? Better, the same, worse? Any other final thoughts?
Be thinking of this like a railroad train where each investment is a car and each one wants to become an IPO, but the engine is slow. So what's happening right now is we have to speed up that engine. And the only way to do that is to reduce the interest rates and get some of these IPOs out the door. Now that we've gotten some, there were only 5 last year, 5 major IPOs. There are more already in the first half of this year. So it's beginning to happen. But we've told people for the last 3 years, hang in there, because 2025, the interest rates will stay low. the opportunities for IPO will increase, and you'll find yourself a much better environment than you would have before, raising money, getting ready for these better successful companies. It hasn't happened to the degree that we said it would. And I'm hoping that that doesn't discourage the investors, but it is going to have to do that to some degree. Bottom line is we're doing a little better than we did last year. The trend is up, but it's not up enough to be shocking. And I'd love to see it begin to increase dramatically, but the interest rates have to come down for that to happen.
Yeah, so I'll conclude it with the following comment, and I really appreciate your insight. I think it's great, and I hope the viewers, see or understand or learn, what we're seeing and apply it to what they're doing, either as an investor or as an entrepreneur. As an investor, do your due diligence, do it right, work with the team, diversified team, make sure you look at a deal from all angles. For an entrepreneur, be careful with your valuations. Make sure it's reasonable from your point of view. You don't want to give away too much money, but make sure you understand your funding strategy relative to the psychology of the angel wanting to have an exit at a certain value to offset the risk that the angel incurs in looking at these early stage deals. Now, I'm going to challenge ourselves at the end of this year to do an end of the year review to see how accurate we are. And I am sure, knowing you for so many years, that you're pretty bloody accurate.
All I can say is what he said. Nicely done, David. That's a good way of capping this particular episode.
And if anyone wants to think about joining an angel group, you can look at the Angel Capital Association for a list of all the groups. But of course, if you're interested in TCA Venture Group, we're at www.tcaventuregroup.com. We have several different entities or networks that you can join. We have funds that you can participate in. We're very active in the ecosystem. You can build a good diversified portfolio, have intellectual stimulation, earn money, and and participate in knowing that you're going to help other people and the economy grow.
That's good.
I know. With that, I wish everybody best in trading, best in investing, and good fortune to all.